When self-insuring, you want the cash value to actually reduce the cost of the insurance until your cash value equals or exceeds the original death benefit. In this educational episode, I'm going to address a question I get asked quite often. Does my IUL actually transfer the cash value in addition to the original death benefit, or is it soaked within it? So I'm Doug Andrew, and I've been helping people optimize assets and minimize taxes now for nearly 5 decades. I'm 70 years old. I'm an old geezer. I have an Apple Watch today, but my first watch was a sundial. That's how old I am. But I've been helping people accumulate money tax-free and then be able to access that money tax-free during their golden years for retirement, or maybe for college funding for their kids, or working capital for business. And then at the end of the day, when they finally die, they want anything they leave behind to blossom and transfer income tax-free. But their primary goal for over 95% of my clients has been to use insurance for living benefits, not the death benefit, okay? Very rarely would they come to me and say, Doug, I want to buy as much insurance as I can for this much money. No, and what they wanted is to sock away a set amount of money, $1,000 a month, or $10,000 a year, or $100,000, or $1 million, and they wanted the best net internal rate of return on that money, so that $1 million would double to $2 million, to $4 million, to $8 million in 22 years. So it was a no-brainer. I structured their insurance contract, their indexed universal life, to have the least amount of insurance the IRS will let us get away with under 2 tax citations called TEFRA and DEFRA. TEFRA is an acronym that stands for the Tax Equity Fiscal Responsibility Act of 1982. DEFRA stands for the Deficit Reduction Act of 1984. That is those are two tax citations that sort of have a corridor that dictate the minimum amount of insurance, not the maximum, the minimum amount of death benefit that you must attach to the account if your objective is to have the money you're paying into it grow tax-free to generate tax-free income later. Does that make sense? So it's the minimum amount. That's TEFRA and DEFRA. But it gives parity. A lot of agents don't understand this. So it doesn't matter if you're setting one up and you're a 22-year-old athletic marathon running female, or if you're a 60-year-old, or if you're like a 78-year-old friend of our family who years ago came in and wanted to put in $500,000, and he wanted to have the best net internal rate of return on his $500,000. He wanted to earn 11 and net 10, which we did. We did it right off the bat. This is pre the TAMRA tax citation that was passed in 1988. So he wanted to put in $500,000 and immediately start pulling out $50,000 a year without depleting his principal. So he had to earn 11 and net 10. Now, he was 78. He had 3 blocked arteries, adult onset diabetes, and a prostate cancer episode. He had 6 sisters predeceased him and 3 brothers. You would think he had 1 foot in the grave. We actually got him approved by 2 different insurance companies, Table D. That means he was rated up 100%. His cost of insurance was double what a normal 78-year-old would be. He was rated as if he was age 83, okay? We were able to squeeze down the death benefit under TEFRA and DEFRA so that he could have the cost of insurance be exactly the same as if he was a 22-year-old female. People don't understand this because they don't know how to squeeze down the death benefit to be as small as possible. He was able to earn 11 and net 10. He was able to put in $500,000 and pull out $50,000 a year tax-free, just like a 20-year-old would be able to do that. And sometimes people don't understand this. So when we're talking about does my IUL policy transfer the cash value on top of or within the death benefit? Well, first of all, it depends upon which death benefit option. There's 2 options. One is called the increasing death benefit. If you choose that, that means the money you're paying in that's growing with cash value, if you die, is paid out on top of the original death benefit. So let's say you're a 60-year-old and you want to reposition $500,000. That would not be a good idea, in my opinion, if your goal is to have a great rate of return on the $500,000 like I've been talking about. Because you put in $500,000 over a 5-year period, and that $500,000 is now added on top of your million if you die. But the insurance company, the rest of your life, is going to keep charging you for $1 million of life insurance, and life insurance goes up every year you get older. See, Dave Ramsey knows this. That's called annual renewable term. The cost of the insurance for $1 million is going to keep going up as you get older. That's an increasing death benefit. The only time that I would recommend an increasing death benefit is if you're younger, in your 20s or 30s, and you're socking away like $500 a month. Then you use the increasing death benefit, and you do that as long as you're funding the policy, 10, 20, 30 years. But once you are through funding it, you've maximum funded it, then you immediately switch over to the level death benefit in order to have the internal rate of return be the greatest and the cost of the insurance get cheaper as you get older. You can't believe how many ill-informed, uneducated people out there. Level is the devil. Oh, wow, what a nice little cliche. No, it isn't. If you're putting in the money within 5 to 10 years, level is the way to go. So coming back to this example, most of my clients, they were 55 to 75 years old, even older. They came to me to have the best net internal rate of return. You want the cost of the insurance to get cheaper as you get older. You want to self-insure. You want your cash value to equal or exceed the original death benefit as soon as possible. If you buy term and invest the difference, that takes 25, 30 years sometimes before your money grows to equal the amount of insurance you took out 30 years ago. You can do that within 12 years with an IUL. So this is what Dave Ramsey doesn't understand. When you choose the level death benefit option with IUL, okay, yes, if I set up a policy and I'm 60 years old and I want to reposition $500,000, I can't do it all in one fell swoop, and it won't be tax-free when I access it. That's called the TAMR law, the Technical and Miscellaneous Revenue Act, that was passed in 1988. So I have to spread it out over 4 or 5 payments. The most I could put in would be $100 to $125,000 a year. So it may take 4 years. But even if it took 5 payments, it's not 5 years. You put in the first 100 of the 500,000 the first day of the first year. And then the first day of the second year, another 100. First day of the third year, first day of the fourth. By the first day of the fifth year, that's actually 4 years and 1 day in, I have my $500,000 in, and now I'm grandfathered under TAMRA, so that my income I take out anytime down the road is totally tax-free. That is worth it. So while I'm doing this, my goal with a universal life is to be able to have my money grow with the best net internal rate of return and have the cost of the insurance get cheaper as I get older. You do that by choosing the level death benefit. So if I put in the first $100,000 and the minimum amount of insurance was $1 million, I could have bought way more insurance than that for $500,000 that I'm going to put in there, but that's not the objective. The objective, what's the least amount of insurance under TEFRA and DEFRA tax citations in order to make sure that I can put in $500,000 and have all of it be tax-free forever after. So it's $1 million, about twice as much as that 500. Now, I can even squeeze it down if that 60-year-old is not in good health. The point is this. I put in $100,000. Now, if I die, my $100,000 is part of the $1 million. The insurance company is only charging me for the net amount at risk of $900,000. Let's move to the 4 years and 1 day into it. I now have $500,000 in there plus interest, but let's just say $500,000. If I die, the insurance company still only pays out $1 million. So my cash value becomes part of it. I could have switched over to the other, but that's not what I want to do because the insurance company in 5 years would still be charging me for the $1 million and I'm 5 years older. That's not helpful when you're trying to earn the best net rate of return. If I earn 11, I want to net 10. I don't want to earn 11 and net 7 or 8. The increasing death benefit, the cost of the insurance keep going up. With the level death benefit, they go down. If you haven't seen an insurance policy that gets cheaper as you get older, you need to study this. And I'll show you, I'm going to gift you a book at the end of this if you want to learn more about it. So let's take that snapshot in 4 years and 1 day. I have 500 grand in there, but if I die, I've said it's okay. My 500,000 is part of the million, but the insurance company only had to cough up 500 grand, the difference. But they're only charging me for the net amount at risk. They're not charging me for $1 million of insurance. They're only charging me for the net amount of 500 grand. So 4 years and 1 day in, the cost of insurance is on half as much insurance as I started with. Is this making sense? The interest I am earning on $500,000 now is way more than the cost that has been now half of what it was 4 years earlier. Well, let's go down the road 7.5 years. Why 7.5? Because I've earned an average of 9.62% ever since 1980 on my universal life and now indexed universal life. Rounding that down to 9.6, your money doubles in 7.5 years. So if I have $500,000 in after 4 years and 1 day, that $500,000 easily has doubled to $1 million by the 12th year. So in the 12th year of this IUL policy, I now have $1 million of cash value. What was the original death benefit? $1 million. I'm self-insured. Okay, that's the objective of buy term invest the difference, to be self-insured, to get rid of your insurance because you now have enough money that equals the original insurance. But it takes 25 or 30 years under their method. I did it in 12 years. This is like buy term invest the difference on steroids. So I have $1 million of cash value. And now what's the net amount at risk if the death benefit's $1 million? Zero. But Teffer and Deffer says, if you want to make sure when you die that the death benefit, the transfer is tax-free, the insurance company must pay out at death a little bit more than your cash value. The answer is 5% more. So when I have $1 million of cash value in there, if I died, they'd pay out $1,050,000. But the insurance company is only charging me for $50,000 of life insurance, the net amount at risk. The cost on $50,000 of life insurance, when I have $1 million in there, the interest on $1 million is probably going to be $100,000 that year at 10%. The cost on $50,000 of life insurance is like $1,000 or $2,000. It's minuscule. Let's go another 7.5 years. The $1 million doubles to $2 million. If I happen to die in that year, then the insurance company pays out $2.1 million, an extra $100,000 over and above my cash. But they're only charging me for $100,000. But the interest on $2 million, which is $200,000, compared to the cost of $100,000 of insurance, even though, I'm now, about 20 years into it? I'm 20 years older. The cost for $100,000, that is so much smaller than the cost on the original $1 million, okay? It's 1/10. And so the interest I'm earning is way more than the cost on $100,000. The cost of the insurance is getting cheaper as you get older. In actuality, if I earn 11% in the 20th year, I'm probably netting 10.8, 10.9 in that given year. Retroactive back to day one, I usually have earned a little over 11 and I've netted a little over 10 because the cost of the insurance at the end of the day only used 1 percentage point. So this is why I use the level death benefit option. If you're trying to do it for the best net internal rate of return, always use the level death benefit unless you're starting out small monthly. And then when you stop putting money in, switch to the level if you want to make sure the internal rate of return is within 1% of the gross rate of return at the end of the day. Does that make sense? So you just learned something that I'm afraid 99.9% of agents who sell IUL do not understand. And they buy into these clever cliches. Level is the devil. I just roll my eyes when I hear that because it tells me instantly that those people don't know what they don't know. So if you want to learn how to do this right, I would recommend you claim a free copy of this book. It's my 11th book. It retails on Amazon for $20 plus shipping and handling. If you buy one on Amazon, thank you, but I'll gift you a copy free. But it's actually 2 books in one. This side is about 200 pages, 14 chapters with all the charts and graphs and explanations if you're a left brain learner. But if you're a right brain learner, you learn more by stories and examples. You flip over and read this book, about 100 pages, 12 chapters with 62 actual client stories. you can use your whole brain and read both books, okay? But if you go to laserfund.com or click on the link below, you can claim your free copy, but I do require some skin in the game. You contribute a nominal amount towards the shipping and handling. I'll cover the rest of that. And I'll fire out a hard copy to you. I'll pay for the book. And I'll do that priority mail. But while you're in there checking it out, if you like to listen and learn, or watch and learn, check out the audio and video formats. But also, you may want to register for a free educational webinar. We teach them weekly at no cost or obligation. In fact, you can schedule an appointment with an IUL specialist at no cost or obligation to see how a properly structured max-funded IUL can be done right, and then you need to rebalance and diversify on an annual basis. Otherwise, you may only earn, 7 or 8 and net only 3 or 4 because your IUL is structured wrong. You did it the wrong way. I want you to earn 11 and net 10, which is a huge difference at the end of the day. That's why if an IUL specialist that I've trained and the group that I train, I've trained over 5,000, they're called IUL insiders. So I'd recommend that you have an IUL insider structure this correctly so that you don't make the mistake of doing it wrong, because then you'll kick yourself 7 or 8 years down the road and have to start over again, which I've seen too many people do that. So this is not about me. This is about you and your brighter future.